Hello, everyone. So we are trying to do both YouTube live and Twitter live at the same time. So I hope it will be working. So we have decided to do a special show today with Bryan. Wait, I'm hearing myself. Okay. We have decided to do a special show today with Bryan because some questions keep coming up when we do the market talk. And they are basically about how to use the tools we are providing on our platform. So the questions usually are about how do I use a trend, the bullish trend, bearish trend, etc. for my positioning? How do I use Hurst? How do I use correlation? Questions. How do I mix all the signals together? So that's the reason why we have decided to do this. So you guys will have open floor later on for questions. You can either write them down in the YouTube comment section, or you can also you will be able to talk on Twitter Space. Okay, so let's get this party started. So Bryan, basically the most important question I've heard so far is regarding trend. So I've talked with you in the past, and you told me that one trigger that you had in your process was the understanding that trend is actually a backward-looking signal, and that the way to use it is not like, okay, this is now bullish, I'm starting a position, this is now bearish, I should get out, and that you can you need to actually mix this signal with something else. So first, can you explain the realization of this? And second, how do you use a trend now versus in the past?
Sure. Yeah, I'd love to run through. I think the best way to do it would be for me to share my screen just so I have my dashboards in front of me and I can just walk through kind of how each thing looks and how it all makes sense together. So regarding trend, so when I first got set up with trading full time and getting plugged in with MFR, it was about a little over 2 years ago at this point. I hopped on right when y'all started the page, and I wasn't on Vi's original Patreon or whatever he had back then, but I needed something initially that was going to be able to generate broadly trading ranges for me and a trend signal for me. I mean, the school of thought that I'd come from at the time, I was kind of a normie back then. It was, okay, if it's a bullish trend, you long it at the bottom of the range. If it's a bearish trend, you short it at the top of the range. And that's where I started. And that's obviously where a lot of people still are. But like you said, like I came to the realization over time that one, trend signals in a lot of ways are kind of subjective. You know, everyone's got a different trend signal, and it's based a lot on what duration you're looking at. So whether you have a longer term trend signal or a shorter term trend signal, it's just been looking back on data that's already passed, and whether that data has broadly been with moves to the upside or it's been with moves to the downside. Now, MFR calculates that in a really good way using volatility and whatnot. But that's all it is. It's looking at data in the past, and if the stock, the S&P in this example, has moved up more, then it's moved down, then it's a bullish trend. If it's moved down more, then it's moved up, it's a bearish trend. And how much in that direction denotes the trend. And so when people talk about positioning, you know, they look at like the CFTC positioning, they've got all their own opinions on whether people are underweight, overweight, etc. The way I look at the trend is positioning. Have enough people bought it over MFR's duration, which is a nice, good medium to short-term duration, to where it's gone up enough over that time. If so, that's a bullish trend. And just because it's a bullish trend doesn't mean that it's going to keep going up or it's going to keep going down. There's other factors that will propel it in that direction. But what is really good about the trend with MFR is that what kind of trend is denotes the upside and the downside. Okay. And now this upside and the downside, it's not really a place where if it's towards the top of the range, that means that it's going to get rejected there and come back down. Or if it's towards the bottom of the range, it's going to bounce there and come back up. It's more about like the risk reward within being in the position and like what your potential risk is. And so like when I first got plugged in with MFR, one of the things that was really valuable for me was being able to take these numbers, the upside and downside of SPY, extrapolate that out to all of my positions, how big I am in those positions, and create like a weighted average formula of what is like the weighted upside downside of my portfolio. So like when I first got started, I was using the trend as a means to identify entering and exiting positions. And then I was also using the trend and ranges to manage my risk. And specifically, I found the most value in it at the portfolio level. So taking that, extrapolating it to all the positions, and then looking at your portfolio, does the portfolio have a weighted upside downside ratio? And that's really how I used it a lot at the beginning. Nowadays, it's kind of skipping ahead once I came to that realization on trend. You know, if you think about trend is as the way of backward looking and have enough people bought it, have enough people sold it, then there's a lot of problem with only being in something because it's a bullish trend on the long side and only being with something on the bearish trend on the short side. And there's especially a lot of problems of using trend as your trigger for getting out of a position. So if you want to be long the S&P here, for example, which I wouldn't recommend, but if you want to be long SPYs, because they're bullish trend and your trigger for getting out of SPYs is a move to bearish trend, yes, that would limit your downside down the line, but it's going to also cause you to wear a whole load of losses because that transition can take some time. And for example, let's say if you bought a ETF like XLU, for example, because it just transitioned to bullish trend, but then it moved to bullish trend and it's been sitting there for a while and maybe you got a little bit out of it, but then it kept going up and then it started going down hard and then it broke to bearish trend. Well, then you made no money on the position. All you did was take a lot of risk in something that was going to eventually transition to bearish trend. So really, like if you think about trend as how many people are buying it at the time and how powerful that buying is in that direction, then you want to buy things with runway. And there's going to be no better runway, let's say on the short side, than shorting a bullish trend and riding it all the way to its transition to bearish trend and beyond. And then taking it off while it's still bearish trend, but towards an exhausted level, both from a near-term range perspective and especially a long-term range perspective. So if we're really talking about nailing something, you're not going to nail something by being only trend-based, because in theory, then you're only going to be participating in a position when consensus is participating in the position. So if you're only buying bullish trends on the long side, you're only going to be long things that everyone's long. If you're only shorting bearish trends and you're going to stick with them until they go to bullish trends, well, then you're going to be wrong with everyone else when they're getting squeezed and getting out of your position. And then depending on how good the duration is of your trend signal, you could take a pretty heavy loss on that. If you have a longer term trend signal that maybe was bullish on the dollar for all of last year up until November, and your trigger for getting out of the dollar was a break to bearish trend, well, then you just wore the entire drawdown from November to January, for example, because you have a longer duration trend signal that was broken then, but it was broken now at the lows, because that's the problem with it. So instead, you could be long the dollar and stick with it last year because of the bullish trend, but then identify towards the top in November that we're getting towards the top of the long-term range in MFR. That will allow you to get out of a bullish trend. And there's no better time to get out of a bullish trend when it's still bullish, just like there's no better time to get out of a bearish trend when it's still bearish. So I think the biggest thing for me was identifying that. It's like you take profits on something and maybe cover an entire position, not when the trend switches, but when it's exhausted, it's still bullish trend, or you don't think there's enough risk there to carry it much further within that trend.
Okay, so we're going to go on how to identify exhaustion points on top and bottom a little after. But first, you've touched some of the questions that one of the questions that we also get is, how do you view in your process, the use of range, longer term range, and of course, upside downside ratio for this respective range regarding your process, and especially if you have to maintain, for example, a long short portfolio? How do you use the two kind of range in your process?
Sure. So the first way that I do use the range is for identifying good positions to enter on the long side or the short side. So when I first developed the page and when I was just kind of a normie, just looking for trends and ranges, I did develop something what I call a signal strength. And so that simply takes the range, whether it's the near-term range or the long-term range. It takes the trend, it takes the volume, whether it's accelerator or decelerator on up moves and down moves, and then it takes implied volatility, whether that's cheap or expensive relative to recent prints, and it gives me a signal strength. And that tells me whether something is a good short or a good long. It's not my main, it's a trigger for me to take a position, but it's not something that I think is necessarily going to be the trigger for it to break. It's basically an idea generator. I have this model that automatically flags to me some things that are good from a risk reward perspective towards the top of the near term range, towards the top of the long term range, is still bearish trend in MFR, and then has a good upside downside ratio. So I take the things that are in MFR, which obviously you guys have here. I still look at this page, but I'm big on exporting. So I have different watch lists that I export every single day. And I just, take the export function that you guys have here, put it into Excel. That gives me the range, that gives me the trend. I then filter it into a simple Excel spreadsheet here that I've developed over time, and it automatically generates these for me. So that's one way that I use the range. I take in all the tickers, which I'm on the 350 package in MFR, taking all those tickers, and then I rank them. Top of the near term range, top of the long term range, bearish trend, that's got a weak signal. Bottom of the near term range, bottom of the long term range, bullish trend, that's got a strong signal. So that's one way that I do it, and that does help me with entering positions. I then, like I mentioned initially, I take that range, I apply it to how heavy I am in that position, and that gives me a weighted exposure of the portfolio of how much I could gain or lose on that position, and then all the other positions I have too. So that's the way that I use the ranges to manage risk. If ever I'm down on a day or up on a day, it's never a surprise because I know what my upside downside ratio of my portfolio and these individual positions were. And I do it that way. And then specifically as well, like I use the near term range, but as someone that wants to get into things like bullish trends, short them into a transition to bearish trend where the most money is to be made, the best thing to look at is going to be the long-term range. And so the way that I view that is through the lens of what I've kind of coined at this point, excess long-term upside and excess long-term downside. And I call that the trend skew in MFR. So that tells you within something that's a bullish trend, how overextended is that bullish trend. The best thing is if you could short SPY in a bullish trend at the top of the long-term range, because that's something Vi's done the back test on it. It's just hardly ever exceeded both to the upside and to the downside. And so that is one of the key things I use to manage shorting something like a bullish trend, because you're up to that point of an exhaustion level and looking at that skew. So I really like to enter things that have not only a good near-term range skew, which would be signaled by my weak near-term signal strength here, but especially I like the ones that show weak long-term ranges, because then I know I'm getting into a position with some excess downside. So most recently, you got a name like Hershey here. It's a consumer staple that I shorted. It's a bullish trend. You look at the chart, the thing's been up on a complete rope all year long. And we got to the point 2 days ago where the long-term range and the near-term range were equal to each other in MFR. Now, this has been a clear-cut signal both when it happens on the upside or when the bottom of the near-term range and the bottom of the long-term range equal each other. On the downside, it's been a clear-cut signal that that bullish trend has exhausted from not just like a near-term, like, okay, I'm going to scalp you 50 basis points in this position type of thing, like this trend, which, I mean, if we look at a chart of Hershey here, where I have your signals layered over on it, Raph, like, I mean, the thing's been up all year long. And so then it stops going up here, the range capped in MFR. And so it doesn't matter at this point that it's a bullish trend. The fact that it's bullish trend, and that was your reasoning for buying it up here 2 or 3 days ago, the fact that it's bullish trend in that scenario is a reason to short it. It's not a reason to buy it, because you know that everyone and their mother is long Hershey for whatever reason. And so I see those skews in something like SPY right now. If we look at SPY, it's not capped, but there's significantly more excess long-term downside than there is upside. So that skew is clearly to the downside. QQQ isn't quite there yet, but I think it's still relatively in play. But you got names like Apple, Microsoft, Meta is capped to the upside right now. So there's a lot of names that have that heavy skew within that bullish trend, that then you can enter something that's a bullish trend with an understanding that your downside risk on a short is capped at the top of that long-term range. And it's highly unlikely that you even really see that because of how overextended it is. So yeah, so to answer your question on that, it's kind of how I use the ranges.
So I want to repeat for the user, you can download this data from your portfolio, and then it's just a basic Excel file where you can see the excess long-term downside, excess long-term upside, which will give you an idea of if this particular ticker is already capped to the upside or capped to the downside. Okay, so
Yeah.
we are not doing some voodoo things here. It's just simple export, then just some basic Excel skills, right?
Yeah, and just to add on a little more, Raph, like a lot of people were asking me kind of like, how specifically do you do this? And this is a process. This is one about like how creating your own process within MFR. It's really simple within Excel. And the best way to learn Excel here is just trial and error. But like, if you can take all that big data from MFR, create an Excel link in here, which is, you just go to the data tab, you just import data right here from text CSV, from web. It creates a link into your Excel sheet, and then just create this kind of large scale table where you just pull all that data in. And then every morning when you go in and you pull from MFR, you just click a refresh, all the fresh data comes in, and then you can layer it over into your own signal strength. You know, I did my rankings on how much I care about trend, how much I care about ranges. And that was a question earlier, like how much I care about trend. I'll tell you, I care about it about as much as I care about the range. It's really not that important to me. It just tells me, like I said, have a lot of people been buying this thing, or a lot of people been shorting this thing. So it's weighted pretty much equally to where something is within its range is how much I weight the trend. And it's also how much I weight the momentum in MFR too, whether there's ups or higher highs or higher lows. Trying to track day to day, especially on a piece of paper, oh, this thing showed a higher high today and a higher low yesterday, and that's 2 in a row, and then it goes down, and now it shows a lower high and a lower here, and it's bearish bullish trade, but it's not bullish trend. It's very confusing. Keep it simple. I pull it all together. You weight how much you care about trend. Maybe you think trend is more important than the range is fine. In a little weighted average format, you can create your own little signal strength here that tells you, okay, something is towards the top of the range in a bearish trend with implied volatility low and weak volume. Let me short it. You can layer over those things. And then we can talk about broadly though, like market from a market risk perspective. So when you take these individual signals on just the stocks, and then you extrapolate them out to the whole market and where everything is, then you can really identify market risk and like what are the key things that are actually going to cause a big dump in the market, which we can talk about in a bit.
Okay, now let's go over to another signal that you are using from MFR. It's Hurst. So how do you use Hurst in your signaling process, and how do you use especially the 3 months, the 1 year, and maybe how you use it for your positions, but also for your macro view about the market?
Sure. Yeah. So for Hurst, I look at Hurst both on the single ticker level as well as on a broad level. So single ticker level, the way that Vi has explained to me and the way that it really clicked for me is, and this is the most simple way to explain it rather than having to try to really look into more extensive explanations. SPY has a 0.66 Hurst. What that means is that if SPY is down today, so it's down 34 basis points today, all it matters is if it was red or green at the close. It closed red. It has a 66% chance of being red tomorrow. That's all it means. If you got something that has stronger Hurst, so let me look at a little snapshot here. Gold has a pretty strong Hurst. It actually has one of the strongest Hursts out there. It has a 0.72 Hurst. Gold was down today. It got absolutely pounded today. Another bullish trend that's been overextended that everyone got long, didn't make any money off, and then lost it all today. 0.72, 72%. It was down today. It has a 72% chance of being down tomorrow. That's all Hurst means. It's looking at day over day continuation of tickers. So it doesn't have anything to do with the trend. Now, if you're in a bullish trend that's been having more up days than down days, clearly, if you're in a bullish trend, then having a strong Hurst helps you carry the upside more. So it's good. So it's a measure that allows you to more confidently bet on day over day continuation of moves. So right now, so I take all these individual Hursts, which most of them are below 0.7, which is characterized as rather weak. I take them of single tickers as well. I take them of bonds, and then I broadly weight out whether the market from both a bond stocks perspective was up on the day. I then weight that together and I make a broad market momentum indicator, which is what I have today, which, by the way, in the recent shock we've seen with stocks down, Qs up, etc., it's been red because Brett's been really poor. So a lot of things under the hood have Hursts that have been pointing down. Nonetheless, I weight them out, I average them, and that gives you this negative 0.47 signal you see on the screen here. And that tells me broadly if I can bet on day over day momentum. 0.47 is pretty weak. I've seen it in the high 0.5s to 0.6s sometimes when Hursts are strong into like the mid 0.7s. So I use it at the single ticker level. It helps me on the margin identify whether I want to stick in a position or not in a position, and categorize which stocks that I press into down moves or I don't press into up moves because they usually show day over day continuation when they bounce. And then the best way that I apply it, though, is at a higher level across all my tickers to identify what's the likelihood of continuation lower. Now, right now, for example, in the market, Hursts aren't great. Like I said, 0.47 is pretty weak. So, and that's been obvious in the fact that SPYs have gone nowhere for however long now, about a month. They've just been chopping. So it's been hard to bet on day over day continuation, but that doesn't mean the market can't go down. It means that the market could drop really hard and then snap back the next day. That's all it means. And so I use it as something to help confirm sticking in a position for me, but it's not the end all be all. It's just one of the factors I use to help make sense and identify where risk is and like whether we can continue in a direction or not. Oh, and then one other way too. It's also very critical when I look at Hurst at a broad market level. Okay, so SPYs were up today, not today, just in general. Let's say the S&P was up today, and then Hurst actually strengthened into that up move. on the up day, that's something that triggers for me like, okay, like momentum is becoming stickier to the upside. Up days are being confirmed a little more with stronger Hurst, showing the likelihood that we actually start continuing higher. And then on market pukes, for example, we saw this in March when we were covering back in early March. The market would go down, and then we would see day over day Hurst get weaker. And so we saw those Hursts get weaker on the down move. And then so that was another thing alongside maybe correlation softening that the market was unlikely to continue lower. So that was another factor I kind of layered on there.
Okay. Another feature that you are using is you are using spreads. So how do you view the use of spreads through the lens of trend, range, long-term range, Hurst, etc.? I mean, how do you use them for, again, maybe macro view, or maybe just for long-short portfolio management?
Sure. Yeah. So there's 4 main spreads that I look at. One's high beta, low beta. Looks like it's having trouble loading right now, but SPHB over SPLV. I look at IWM to QQQ. I look at IWD, which is the value ETF, to QQQ, and then XLU IWM, which is Buy's favorite. And so from a market level, I use especially XLU IWM and SPHB over SPLV as a risk on, risk off signal. So this is aside from trying to trade the spreads. I use them as something that signals to me what's really going on under the hood. And so high beta, typically, if we're looking at a BMR that might have some more room to the run to the upside, high beta will lead on the up move. So SPHB over SPLV will bounce with the market, which helps lead an understanding of whether a BMR could continue. If you look at what SPHB over SPLV did, for example, in January, this was the key signal back then. That's really when I started looking more closely at spreads. It completely ripped. And this was happening while SPYs were consolidating sideways. So right now, for example, that's a key thing to watch while we're consolidating sideways here. What does high beta, low beta do? Does it bounce? Does it go down, etc.? So I look at it from a macro perspective and from a market perspective of what's going on under the hood. How I use them, I don't have the ability to layer over my own signal strength on them, but I look at them just from a higher level perspective of how strong is their trend and how much runway is there within that trend. So for example, XLU IWM has a strongly bullish trend, has a pretty good Hurst Exponent too. That means that up days are typically followed by up days, down days followed by down days, which is what you had on a down day today for XLU IWM that followed yesterday's down move. But it has a good upside downside ratio and a good long-term upside downside ratio. So that tells me that there is room for defensives to continue outperforming cyclicals. So I like looking at spreads, especially from the long-term range perspective and from a trend perspective of, okay, there's still room. We haven't exhausted the outbid for defensives over cyclicals, or at least the relative better performance on a down move of defensives versus cyclicals, which would be a risk off signal for me. And then the same goes for SPHB over SPLV. That's a pretty weak long-term upside downside ratio within its bearish trend. So that tells me that there's more room to the downside for high beta to lead lower versus low beta, which is something we need to really have a good market puke. So I look at them like that. If that trend started to shift, if we were continuing to chop here and SPHBS over SPLV was up today again, if it's up again tomorrow on like an equity bounce or a sell, that tells me that risk isn't really building for a good breakdown, and high beta continues to outperform and it's not getting sold as aggressive as I would like. That tells me that risk isn't high enough to continue trending lower too, especially if that trend starts shifting to neutral and bullish. So I use them from a market risk perspective. From a trading perspective, I've actually had a lot of success recently trading spreads. I don't trade them actively. I like to get into spreads that have a macro perspective. They're bearish trend spreads. And then I go long that spread that has a really good upside downside ratio. So I like spreads that have gotten like completely pounded towards the bottom of their long-term range. There's very limited long-term upside downside, and then thus low risk to long that spread and wait for the move to come. Most recently, I did this with XLU IWM back in February. So if we remember from December to February, during that huge market down move, huge market squeeze where high beta was leading higher, defensives got sold versus cyclicals. And this one got hit down completely towards the bottom of its long-term range. I longed it a little early. The yellow arrow here is where I went long. I learned my lesson a little bit there, but I went long it, added more down here. It got very close to the bottom of the long-term range. And then I just waited. It was still bearish trend, but the long-term upside downside ratio remained very good. And I knew that it had an inverse correlation to SPYs, which you also can get in MFR. I run it myself, but you can also get them in MFR down at the bottom here, what the correlation of that spread is to SPY. So it had an inverse correlation and a really positive upside downside ratio from a long-term range perspective. Again, there's no better thing to long than something that's a bearish trend moving to a bullish trend, and then you get off of it at the bullish trend. And I did that. And so I stuck with it here. Once the risk off event in March started working, that spread completely ripped. It realized all of that upside from a long-term range perspective. And then I took it off around here because it got towards the top of the long-term upside range in a bullish trend. And then I haven't gone to it since. So that's how I trade the spreads. I like to get into them because if they have very positive long-term upside downside ratios within their bearish trend, get into them and wait. One that I did it with that didn't work out, but I did get out in the nick of time was IWN over QQQ. So this one got completely handled during the banking event. It got completely whacked. And right here, I actually waited more patiently this time towards it got to the bottom of the long-term range. I longed that spread right here. The long-term range remained positive. It was still bearish trend. It started going sideways, which was good. So that was another reason to long the spread and give it a shot. Okay, if cyclicals might outperform in a BMR, which I know is coming here in March, maybe this is a good one to take because I think bonds will get hit in the move. That didn't end up really happening. It's starting to happen now, but it didn't realize it. But nonetheless, the long-term long in something with a good long-term upside downside ratio allowed me to get in it and wait and not lose any money through here. And then around here, we started seeing the long-term downside open up. The trend wasn't shifting like SLU IWM did, and I got out of the spread. So at a small loss, I got out, and it's continued going lower here. And you're getting mega buys here, Raph. So maybe it's time to go for it again. It's not good in MFR. There's really no opportunities on the spread side right now that I'm interested in. But that's the way I do it. And so what is a good way to also do it if you're doing it at the single stock level is if you see a stock that's a bullish trend that you want to short, that might have a cap on the upside, like Meta, for example. And find something that maybe then is in a bullish trend along, and then that you look at that, you combine the spreads together in MFR, which you can with all the tickers you have. And then you might find something that has a good long-term upside downside ratio. Maybe it's already transitioned from bearish to neutral trend. But generally, I only like getting into spreads that have a really good long-term upside downside. So that's the way I look at it like that.
Okay, very good. So you've mentioned several times today that you like to identify exhaustion points on top and bottom. For example, I remember during the previous sell-off, you actually handled pretty well the bottom of the previous sell-off, right? When we got the banking crisis bottom. What triggered you to cover your shorts and actually go long there? And in general, how do you identify these kind of exhaustion points for bottom and for tops? What are the inputs for this?
Sure, I sure can. A really good thing for me to do, maybe I could pull it up. It'd be hard to pull it up, but yeah. So for the March lows, I started deleveraging around, or I didn't deleveraging. I took off all my shorts right around here, the Thursday after the low in March. And one of the key things then for exhaustion, well, the number one thing, like I mentioned for exhaustion, is you're looking for bearish trends that have the downside cap. So what that means is that the excess long-term downside is the same thing as the bottom of the near-term range. So if there's 0% excess long-term downside, that means the bottom of the long-term range equals the bottom of the near-term range. That's going to be the number one signal for exhaustion of a bearish trend. If it's bearish trend, it's gotten sold a lot recently. You're selling down to the bottom of the long-term range, and then the downside caps. That's going to be the number one signal for exhaustion to the downside as well as to the upside. You don't always get that. So I'll get into what those other signals are, but if you just held to that rule and you see any time where that happens, get out of the position. Most recently, it happened on XLE. It happened with a lot of defensives as well, like XLU. And I think it was right around here, actually. I should have shorted it. So I think I thought it was going to rip like everyone thought, right? Sorry, I wasn't muting myself, and I just unmuted myself in the Twitter spaces. Looking for the number one thing for exhaustion is if the excess long-term upside and the excess long-term downside equal each other. So if you look at XLE, for example, right around here, the upside in MFR capped, there was 0% excess long-term upside, and it didn't go any lower. And then the capped, it went, and now look what's happened. So that's going to be the number one signal that I go for exhaustion. Next to that, which is just as strong, and this one will fire more regularly for you. You're not always going to get the cap to the downside or the cap to the upside, but the other one is correlations. So correlations are going to be what we talked about in the last market talk. The best way that I can explain it, from my understanding, is it's a measure of market instability. Okay, so from a market instability perspective, how much gusto, how much strength is there for the market to continue where it's going? Is risk high enough for the market to continue selling lower? And in order for risk to be high enough for you to continue breaking lower, you need correlations to be high, whether that's going to be equity sector correlations. So all equity sectors are selling together, and that could be defensives down less than high beta, but it's red with the rest of it. Next to that, you want to see bonds selling with it as well. Whether we're in a regime where bonds are a bullish regime, or whether you're inflationary and bonds are not bullish, or you're in deflationary and bonds are bearish, for a real good sell-off, you want everything selling with the dollar bidding. That's why inflationary risk off has been some of the biggest pukes we've seen in this bear market, because we've had bonds selling with dollar bidding and all equity sectors selling as well. So a sign that the market could keep going lower is correlations going to and remaining at extremes, or continuing to build into that move lower, which is what we're starting to see today. So when I think about exhaustion and whether a market can continue to going lower, or if I'm going to pivot and try to call for a BMR like we did in March, I need to, like, for something to continue going lower, I need runway from a long-term range perspective. So no cap on the bottom, still downside in the MFR range with a lot of room to go. Like right now, the long-term skew on SPY, the long-term downside is down at 387. So this is nowhere near exhausted on a down move. It's nowhere near oversold on a down move. And when I say oversold, I don't look at oversold on like a day-to-day basis where the oversold signal can come today, leave tomorrow, and then come back the next day. I don't I don't play for daily moves like that. I play for large trending pukes when I'm trying to short this market, where I have runway down to 387 on a long-term range. And when the trend on SPY starts breaking, that'll drop lower. I know that too. And I have correlations all playing. All equity sectors are selling together. Stocks and bonds are selling together. And things are breaking from a trend perspective, and the dollar is bidding. So that's how you can use the number two things for exhaustion: the long-term range skew and correlations. Those would be the number two.
Okay, good. So maybe we've been asked to talk about if we are seeing any change regarding the market after our previous market talk, and then maybe we go to questions. So very briefly, has anything changed in your mind compared to where we were before?
I think in the last market talk, I was bearish, but I wasn't really completely there yet. The biggest thing that's flipped recently is stock bond correlations are positive now. You saw it into the close today with equity selling, bonds didn't bid, gold got hit today. So correlation risk today took its biggest improvement in 2 months. So that was a really big day. And that was really the missing piece for me before I got aggressively short. And I've been aggressively short since Friday in terms of calling for doomsday and market toast and whatnot, is correlations. Those have really started working in our favor. Bonds are not the risk off play right now. They will get whacked. If you bought bonds and you bought gold today, maybe you'll get scalped for 50 basis points, but otherwise they're about to get absolutely handled unless you get another bank blow up. So that's all you can really play for. Quite frankly, back in March, all the bond bulls and gold bulls too got completely saved. I will say, speaking of the cap on the long-term range, and I missed this and I chose to ignore it, and I will never do it again. Before the bank blew up, you remember this, Raph, the long-term downside in gold was capped. It was at 0%. And the long-term upside in dollar was capped too. It was at 0%. And I didn't know what that meant because we thought that equities could continue selling, which was true. We were right that equities could continue selling, but then they started selling in a deflationary risk-off manner where gold bid, dollar went down, and bonds bid as well, and equities continued to sell. So that was like MFR through all, like with identifying no more downside in gold, called that out. So that's something to look out for again coming recently. But that's not happening right now. Right now, I see gold crashing. It will break trend eventually. Correlation right now between SPY and gold is positive, firmly positive, even stronger than SPY TLT. SPY gold is a 0.8 correlation here recently on the 5-day. That tells you that people are starting to sell gold with their stocks as a means of gain liquidity. So there's a huge put option in being short gold right here because they're going to have to sell it, and you could easily get a 3 to 4% down day on gold, no problem, when everyone's selling their stocks and their gold, which would be absolutely great. And it was also an awesome hedge. I mean, being short gold today saved me from my mega cap tech puts that got completely blown up. So it's like you have to kind of balance it out like that. Like being long dollar, short gold today was, and even through this recent move, because gold's actually gone nowhere. People are acting like it's so bullish. I mean, it's gone nowhere since middle of March, like after you had the initial get-go of the banking crisis. It's gone nowhere, but everyone's been talking about we're in a raging gold bull market, but it's about to completely just crash, which is awesome. Nonetheless, the biggest thing that's changed, Raph, is correlations. And then I'll say one more thing, because I talked about correlations, but then I didn't talk about gamma regimes. So I'll talk a little bit about how I influenced that in my process. Before I started getting into correlations, somewhere in between looking at being less trend-based and looking more at market risk and the trend skews on the long-term range side, I started getting into gamma regimes. And this was a really big thing for me too, because this is the key to me knowing, alongside maybe Hurst Exponent that tells me if a trend can continue, the gamma regimes tell me whether a big market sell can continue and whether we're in a place where volatility VIX can continue bidding. And so I've now segmented out. I have kind of my own tool that I can easily refresh here day over day. I'll just give a quick run through for people on this. There's 4 main levels. There's the call wall, there's absolute gamma, there's gamma flip, and there's put wall. There's just 4 levels. You don't need to mark every single strike on your book. You don't need to really get into very little details of how things are behaving at every strike. Just focus on the 4 levels. The call wall is upside resistance. That's going to be the strike with the most net call gamma. It's very difficult for spies to get through that, especially if the call wall is also absolute gamma. Absolute gamma is the strike with the total amount of both put plus call gamma. So if you look at it right here, 410 right now, so 410 is absolute gamma. So that's going to be the vol bidding, vol crushing level. If you are below absolute gamma, vol is likely to remain bidding, to remain bid. If you're above absolute gamma, you're in a regime where they're going to continue crushing VIX, and it's going to be hard for it to really hold a bid. So if you're going up to a call wall that's also absolute gamma, which I gave the alert out here this afternoon on QQQ, it worked like a charm, I'll tell you. This might look, there we go. Yeah. So 330, when we were pushing higher here into 327 earlier today, 330 was both the call wall and absolute gamma. That tells you that people are buying just a ton of calls up there, and they're buying so many calls that it's both the largest strike from an absolute perspective, both the puts and the calls of that strike. So that tells you that if the market doesn't get above absolute gamma, and it's a call wall, so it'll be hard for it to get above at 330. If it doesn't get above there, that's a lot of people that have options that are either decaying for 0 DT today, or they're decaying for 5 DT tomorrow, or they're decaying for a month. It doesn't matter. I don't care whether it's 0 DTE or middle DTE or 2-year DTE. That's not a factor for me, because I add up just what the total gamma is of those strikes, and they're decaying and losing either way wherever you are on the curve of 0 DT. The 0 DT, the only influence it has is that levels change more quickly, and they can be more adjusted more quickly. So that's why it's important to really watch this kind of stuff multiple times throughout the day. That's the only impact it have. 0 DT guys aren't manipulating the market, and they're not the reason for the market rallying, etc., and blaming it all on them and whatnot. That's not the way to do it. They just change the levels more quickly. And so today, the 0 DT crowd was out. I'm sure they were buying 330s. They got 330 very aggressive. Qs could not get to 330, and that then elicited major call selling at that level, which was likely the trigger for the selling into the close today. So below absolute gamma, you're more likely to hold a bid on vol. Then you look for gamma flip, and that's going to be the trigger for vol to really bid. Below absolute gamma, it's going to hold a bid, maybe come up a little bit. It's a more of a vulnerable position for the market, but you're not really going to get that huge bid for volatility like you would if you break absolute gamma right now, which is 410. So that's going to be the most significant put strike near below absolute gamma, or at absolute gamma. It could be both. Like absolute gamma could be both gamma flip and absolute gamma. They meld together, these strikes. But once you break that, then you're moving to put dominated territory. The implied move on a day-to-day basis increases, meaning you're more likely to get larger moves when you're in negative gamma territory versus when you're in positive gamma territory. Realize volatility is lower in positive gamma as it is versus in negative gamma. And so then when you think about that from an MFR range perspective, if I have a lot of excess long-term downside, how am I going to realize that? I'm going to realize that by breaking into negative gamma and getting what we all want as bears, the 2-3% down days. Those don't happen when you're in a positive gamma regime above absolute gamma, above gamma flip. They don't happen. They happen on the breakdown. So it's really important to know what gamma regime you're in, because then you can't be surprised when we get what we've had over the last 2 weeks with the market just being flat. Like, it sucks. I wish we would get these huge down days so I could start making big money on my shorts, but we're not in a regime yet where it's even possible. you have to break into a regime where puts are dominating and causing more volatility for you to get the big moves that MFR's ranges say are possible. So what that means is that it doesn't matter if something's a bearish trend or it's a bullish trend. If you're not in a regime that's going to cause enough volatility for you to realize the downside or provide enough support for you to realize the upside, well, then it doesn't matter what the ranges say. The ranges are going to keep moving lower. So for example, some people might have been long consumer staples most recently. Some people might have been long gold most recently into this move. Those were significant. I can't say it about gold, but let me rephrase the thing here. Some people might be long SPYs right now. Let's say someone has a range where this was the bottom of their range on SPYs. The upside downside ratio isn't good, et cetera, et cetera. Right now, I actually don't care at all what the range on SPY is or what anyone's range is or what MFR's range is right now from a near-term perspective. I care about the long term because I want to know that I'm in positions that have runway in that direction. But I don't actually care what the upside downside ratio from a near-term perspective is right now, because I know that correlations are high enough and 410 is just below, and that's a huge trigger to where we will shatter through whatever that person's anyone's near-term range is tomorrow if we get that breakdown. It doesn't matter what the range is. There's no bottom. A range isn't stopping you on the downside tomorrow. Now, it's good that MFR's range, for example, shows 2% of downside down to 403 tomorrow, which could easily be realized on a negative gamma breakdown with correlations blowing out. And so you have to think about that from a range perspective. Like, it's not like that tells you what could happen from a near-term perspective. The long term is going to be the most reliable because then you know broadly where you are within the current trend and whether we're overextended or underextended. But otherwise, like the triggers like correlations going and then you breaking down from a gamma range perspective, those two together, those are the things that get you the real market move. And then just wrapping up on this point, below gamma flip, you have the put wall. And the put wall is the most significant put strike, so the largest one in the downside, and that's going to be downside resistance. So alongside back in March, where we had the long-term downside getting capped, we had correlations starting to soften because people were buying bonds, flipping stock bond correlations negative. People were buying NASDAQ, flipping sector correlations weaker. We also were down towards the put wall, which I think was like 385, 390 at the time. And people were chasing puts into that strike, making it absolute gamma on the downside. So then not only, I was just talking about how QQQ 330 was both the call wall to the upside and absolute gamma to the upside, which means we're unlikely to break above it. The same thing can happen on the downside. Both the put wall and absolute gamma can become the downside strike. And then if you don't break through that, then vol will get absolutely crushed. And if you're down at the put wall, you likely have VIX up into the high 20s, which is what we had in March. And then that's how you get a sustainable BMR. So what happened in March was we started from a place where VIX bid. IV ranks went up to about 40 to 50% on IWM. And I think they were in the 30s on SPY and QQQ. So it was not an aggressive sell-off at all. It was actually rather depressing when I saw that we were likely going to have a BMR and not go any further. But what you had was vol was very well bid in March. You had people buying bonds because the Fed was going to cut, which then puts us in a negative stock bond regime correlation, which if you think about it just from a reason perspective, okay, every time stocks go down, we're going to bid up rate cuts. Every time we bid out rate cuts, that means the economy isn't that bad and we're not going to recession. And so we're going to bid stocks. It's a never ending cycle that just ends up in volatility getting crushed, which then from a high vol regime where you're above the put wall and you're above absolute gamma, and then you recapture gamma flip to the upside, which just causes people to start chasing with calls to the upside. That's the catalyst for a 2-month BMR, which is what we've seen. And now everyone's gotten whacked. And now IV ranks on QQQ are down to 0% almost. So some of the cheapest volatility we've seen. So now it's the complete opposite of what it was in March. And so you need to understand where you are within a range perspective, where you are within a gamma range perspective. Are we in a regime where we can get big down moves, or are we not? Where are we within a volatile perspective? Is vol cheap or expensive right now? Are we in a place where there's room for VIX to crush more? For example, right now, we were talking, Raphael, if we don't get a puke here in the next few days, next week, they could go crush VIX again. And let's say they crush VIX from this level right now. Okay, they're going to crush VIX down to just 0% IB ranks across the entire board. And what does that really mean? It just means like some very like out there, like not very strong puts get squeezed. So it's like the upside in some kind of continuation squeeze. If we do get another VIX crush next week, it's not the kind of squeeze that we got in March. You're not going to get that because there's just not enough puts to cause that again. So that you have to understand where you are then within those regimes. And so if you're scared about another VIX crush, like, okay, what does a VIX crush mean for me? Well, VIX crush means for me, my puts get whacked. And then let me look at MFR ranges. Okay, so this is how much we could potentially move up in that kind of environment. But could we really move up that much? Where's the call wall on SPY right now? Well, it's been anywhere from 415 to 420 here recently. And absolute gamma gets up to that strike every time we get up to 415, 420. And so then I'm like, okay, the MFR range right now says that we can go to 423, but I know that 415 and 420 are very hard resistance. So I don't think we realize that. So I can discount really that downside for my risk here. And I can just look to what is available, 403 and 387. So it's good that like MFR is separated from these other tools, because then you can look at them and segmented thing. MFR isn't looking at what the gamma range is. Now, if the market starts moving really quickly and realized volatility comes up, the ranges will widen and it'll start to factor that higher volatility regime in. But right now, it doesn't care that we're in a positive gamma or negative gamma regime, and it's not looking at where the call wall and the put wall is. So you can layer over another kind of ranging process on top of that and look at it through that lens as well. So.
Yeah, I forgot to mention this part actually. I know you are using this big time in your process too. Quick side note that we have a release not this weekend, but the weekend after. So I will make a post on the MFR Twitter page later next week. And then we will work on adding gamma to our software. And second, Vi wants to have a correlation page that users can actually, how to say, tailor use. So basically, they can do the 1 day to 1 year correlation by themselves, not something static, something that they can use. We just have to decide which thing we're going to do first. So anyway, that was a side note. Quickly regarding my views, so I've posted my views. I like the fact that trade and trend of vol of VIX have crossed each other. This is usually the sign that shorting volatility is no longer a good idea, and you usually get a VIX spike in the coming weeks above 30. So that would be my bet. I don't have a time frame. What I like too is also Apple. I have posted the trade of volatility of Apple. So I have also explained this principle in the past. I mark the minimum where the trade of volatility of an asset can go. I've done that before with gold, with Euro USD, etc., and it has worked out pretty well. And Apple now, its vola trade is at the minimum it's been for the past 3 years. So 3 years. So my bet is Apple is going to take down the market. I don't know the trigger. I don't know when, but it's. I mean, now anybody's long Apple, you have a death wish. Okay, you really have a death wish. So yeah, that's my bet right now. One concern I have, and I have been concerned about it for the past 3 days, was we had a window of weakness from last Friday until today, and we didn't have the bid on the VIX, which was quite concerning to me, especially as this window was in my mind starting to close today and maybe tomorrow. And right at the close today, we had the VIX spike. Okay, so we have to see if we can get some continuation tomorrow. Continuation tomorrow on volatility would be great. If not, it means we may lose another week, maybe to rebuild the risk for VIX to spike. So for crush, wait for a cycle to start over on short term before we get another rip on VIX. So we're gonna know tomorrow. Tomorrow, if we get continuation, we probably blew through the 4110. How do you call this? Gamma wall?
Yeah. It's gamma 410's gamma flip and absolute gamma. So like vol VIX bids mega hard if we snap through that, especially with how correlations are now. Like if you get like they'll blow out. I mean, we could gap down really hard tomorrow. Like we're so close. So you have to look at it like correlations are high. Vol is very cheap. There's no reason big boys shouldn't be buying puts right now. I brought Apple up on the screen. It closed right at the 0% IV rank again. And you look at the long-term trend skew here. There's plenty of excess long-term downside. There's plenty of room for Apple to puke right now. It's bullish trend. And like we said, what does that mean? Everyone and their mother's long Apple. Everyone knows this. So like the fact that it's bullish trend should make you want to short it more right now, not short it because it's bullish trend, right?
Yeah. So basically, to make it simple, on my perspective, tomorrow you want VIX above 18. Okay, you want it to stay above 18. This is critical level. Then you add on that what Bryan told us very well. Okay, guys. So now we're gonna move to questions, because the idea of this video was not to do a market talk episode 2. You know what we think about it, but it was a question somebody asked about it, so I promised we would do a quick parenthesis about that. So now regarding questions, first I'm going to go to YouTube. Okay, so we have Ama making a joke about Apple. So yeah, he knows my view. Yeah, if you are long Apple, you should be very scared. Second, so Lee is asking, do you have any insight or comment about how SPY below 110 equal gamma flip last Friday during the market session, but closed in positive gamma? How unique was this move, and how surprised were you? Thank you. So yeah, we had a move below 410 last week, right? And they managed to save it. So what did you think about it, Bryan?
Yeah. So no, I wasn't surprised. I think the reason that we didn't get it on Friday, a couple. One, I believe that a 1 sigma move on Friday was to 410. So it's the same idea with like in regimes where negative gamma, you can get more intraday, larger intraday moves, positive gamma, you get less intraday moves. I calculate out what's a 1 standard deviation move based on what the gamma notional is on the open. That was only for a move down to 410. I did say in my notes, I think it's Ashley that's asking the question, Lee. He's on the Patreon page. I think I said that we could easily break through, and it just didn't happen. Correlations weren't as strong into that test of 410 as they are today. So I think we're more likely to break through it tomorrow. And yeah, we didn't break through it. We didn't push for a multi-sigma move. They recaptured 410, which was absolute gamma and gamma flip. So they completely crushed vol after that. And it just is what it is. But here's the thing. Yes, we got a VIX crush on Friday, but like I was describing earlier with how cheap vol is, what has it led to? If we look back and review what happened on Friday, which is right here, it led for a move up to 412. On Monday, we had follow through up to 413, and now we're back to 410. There was no gusto. There wasn't enough vol bid for that crush and recapture of 410 to be anything more than that. So that's why I really don't care that I got squeezed on that day and that we didn't break 410 and we're coming back for another test now, because I knew there wasn't enough for it to go beyond where it went. And so that's what you have to, when you think about how expensive vol is right now and what a VIX crush means for my portfolio, it meant a lot different on Friday when we recaptured 410 versus back in early March when we recaptured 385 or whatever it was. It means a lot different. One, you have a likelihood that it easily mean reverts, which we've already seen this week. And the other, you have the likelihood of getting your face squeezed off for 2 months at a time. So, yeah, it happened, but I'm okay with the risk reward of holding through some of that, because I know how much money I'm going to make when we break 410. Like hopefully, then we were tweeting it out. Hopefully a lot of you got short back in March, but those were like 2 to 3 days of amazing downside using this process. We're in the same situation right now. The squeeze to the upside, it happened. It mean reverted. It was light. I've already made back everything that I lost because of the squeeze. And now we're coming back in for a likely break of 410. So that's the way I view it. Was I surprised that it happened? Not really. But I think we're going to break 410. It's inevitable. It's programmed, as they say.
Okay, let me check again, YouTube. Will a recording be available? Yeah, of course. We're gonna, when I stop the live, then I will post the video on our YouTube page, and also I will post the link on our Twitter page for the link to the YouTube video. Okay, nothing else on YouTube. Let's move to Twitter. So if you have any questions from the Twitter, anybody in the Twitter audience have any question, please manifest yourself. I think you are able to do this. You can request you can request to talk. At least that's how it was working pre-Elon. Anyone has a question? Raise your hand or signal it. Okay, nobody. Yeah, nobody has any question. Okay, so I hope it's because we covered everything people were wondering about. Yeah. So Bryan, you see anything we didn't address? I mean, I think we covered pretty much everything.
Yeah, no, I think we did. I think I wrote down some things about like how my process has been developed with MFR over time. And we pretty much hit on everything. Like I started out with just normie ranges, looking at trend and ranges. Then you start becoming less trend based. You can really just look at ranges as a risk management thing, identifying what your exposure is to upside, downside risk. Then you layer over a long-term range perspective, which allows you to have a better idea of kind of where you are within the current trend. Are you more skewed to the upside or the downside? Gamma ranges, correlations. And then I had some notes here of just like, what's the perfect short? You know, so when I first created the single strength tool, I was trying to create what the perfect short was from a MFR perspective with the trend, the ranges, implied volatility, etc. But it has less to do with this and more to do with all the other factors that you're going to look at. So the perfect short has the following breakdown. So first, it's a bullish trend. That's going to be the perfect short, something that's been a bullish trend that everyone's long. 2, something that has a lot of excess long-term downside, has long-term runway, as I like to call it. So the trend skew is significantly lower. Hershey was an example. I have another one. Let me look at like Skechers. This was one that I shorted today. Skechers had a upside long-term cap, plenty of excess long-term downside. This is the perfect setup for something that's about to break bullish trend and move to a bearish trend, which would catalyze even more downside and more selling that you're already involved in. And you're not waiting for a bearish trend to short. So something that has long-term runway. The broad market is in a negative gamma breakdown. So you're breaking through 410 in this example, where volatility will be bid. The market is more unstable. Something that has low implied volatility. And some people use IVol premiums discounts. MFR has those premium discounts in. I know you were asking about it. I look at IV rank, especially right now with our vol so low. Implied volatility premiums and discounts don't actually really tell you that much because it's skewed higher based on the current level of our vol. So it's telling you that, yes, based on the current amount of realized volatility, puts are well priced, which has been giving people reason to sell more vol, but it doesn't tell you based on where you've been recently, how cheap or expensive are those puts. So right now you could look at QQQ, and some people would say don't short QQQ because it has an implied volatility premium. Well, if you look a little closer under the hood, that in premium is because our vol is so low. And if you look at the IVol itself, you'll see it's at one of the cheapest levels for the entire bear market. So you want something that's at an IV rank of 0%. You want high correlations, and that's going to be positive sector correlations, positive stock bond correlations. And if you have all those together, which there's a lot of names out there that have those all together, and I've shorted a lot of them on Twitter for you guys, that's when you get the big down days. And then I'll talk about one thing from a macro perspective. So you'll see on all my sheets here, this might be a good one. There's a bias. Short bias, short bias, short bias, long biases across the board. There's a thought. Some people have this perspective, like, just do what the market's doing. You'll go to the signal first. And if it's in a bullish trend, it doesn't matter whatever the macro perspective is. I'm going to stick with that. I'm going to do what the market's doing, and I'm not going to tell the market what to do. I had that perspective for some time. And it certainly helps you avoid losing money, because then you aren't like stuck in your bias, and you won't stick around on a position just because you have a macro bias and you keep getting squeezed to the upside on short Qs right now, for example, or since March, because you have the bias that we're in a bear market and NASDAQ should be selling, and you're ignoring the signal and you keep getting squeezed, and then people get into a position like, okay, I'm only gonna short bearish trends, and that then you get in this self-fulfilling thing where, like, okay, now I'm never gonna short a bullish trend. I'm gonna result on that, because that's been the all telling thing for me for why I was shorting Qs, and I just had this macro reasoning for staying around and shorting Qs. I actually always start with what should be happening, because I start with like a pure fundamental macro bias, my opinion of what should be happening. Right now, all of this year, Qs should have been selling. They should be down. I start there. And then that allows you to know what to look for, because you can't get on the right side of a really good trade like right now if you don't think that Qs should be going down. You don't have the backing, the fundamental backing, and the understanding of why you want to be short Qs, or why I want to be short bonds right now. You want to be short bonds because the Fed is nowhere near cutting. So you put those things in perspective, and then you're like, okay, the NASDAQ should be going down. You have that perspective. I'm not interested in long in the NASDAQ right now because it should be going down. And then you layer over the trend signal on that. What is the trend doing? Okay, it just flipped to bullish trend, and there's plenty of excess long-term upside, and market risk is still very low, and vol is still getting crushed from high 20s to wherever it's going to end up. Well, then you say, okay, I know that Qs should be selling, but then I don't have anything to tell me to short them right now. So I would really get to that. I know a lot of people got squeezed here and since March, shorting the whole and whatnot. And you're telling yourself right now, I should be doing this. I need a trend signal that's slower duration. I'll never short a bullish trend again. Don't do that. Start with what should be happening, and then find a way to enter those positions when consensus is completely on the side of what the signal says and it's overextended. And then you're really going to be able to express your bias of what should be happening. I thought that gold should have been selling this entire year. It should have been selling since March, but everyone's been chasing gold for whatever reason, even though the Fed hasn't been loosening policy at all. And maybe you can consider them loosening around the banking crisis. That's been the catalyst for gold to bid. But I thought gold should have been selling. I also thought gold should have been selling harder in March, and I ignored the MFR signal that showed the long-term downside cap. So there's an example of where I let what should be happening, this massive gold puke, which I was expecting, caught me in the back. But now, if I didn't think that gold should be selling right now, then I wouldn't be sticking in the position because nothing from a trend perspective tells me. So I would push people to have a macro bias and to not try to ignore those bias and become completely agnostic. Think about what should be happening and then layer over the signal on top of that.
Okay, that's very good idea, Bryan. So yeah, I think we covered everything. So guys, again, number one, you can see it's very easy to build your own stuff, right? I mean, Bryan has introduced a lot of ideas that you can start working on. Just download this thing and start building some stuff. We also have API open for people with more than 200 tickers. So basically premium plus 150. We're gonna lower this to premium plus 100 on not this weekend, but the next weekend. And at the same time, we're gonna publish a TradingView script for trend that will also be available for the same kind of user. So premium plus 100. So yeah, anyway, so you can build your own stuff either using the export function or with the API if you have more if you are more sophisticated and maybe you are using Python, etc., and you want to go deeper. Second, you have to unlearn a lot of stuff, right? Some of you have been taught like it's bullish trend, I buy. It's bearish trend, I sell. When it turns bullish, I start to buy. When it turns bearish, I get rid of the position. And you end up sometimes you end up buying a position right at the turn before it actually crash, or you end up closing a position right before it bottoms. So you don't want to do that. And you have all the tools available on the platform to build something better, to unlearn some of the bad habits that you have had, and get on a new train with some good habits. I think Bryan has showed that. Okay, so I don't see any other questions. I mean, I hope you will not ask some more later, because we are doing this show exactly for that. So yeah, last 5 seconds. No other question? Okay, we're good. Okay, guys, so I'm gonna stop the recording. Then tomorrow morning, because it's already very late in France now, I'm gonna do the chapters on this video and I will repost it. So you will be able to follow the chapters about trend, Hurst, what have you else, gamma, etc., that Bryan have talked about. I may also cut some pieces from this interview to repost them separately, so you guys can go through that, and maybe it will help you to build your own process. Okay, guys, so put in the work. I don't think it's a big amount of work. I mean, it's what maybe several days of maybe 2 hours work just to build your Excel file at first, and then you can use maybe GPT to help you build this thing. Okay, so thank you, Bryan. Thank you very much. I hope it was useful, and see you later for the next market talk.
All right. See you, man.